But hey, I am excited to share. You're doing a great job going through this new book that we have at the Potter's House. And I hope you're really enjoying it as much as I have been. To watch you guys work and see you stretch yourselves and the answers that you come up with has been really encouraging. So, hang on a second. Got my tea again. All right. This is lesson 13. So we're really doing well. Marking period ends next week. So we're really, really on task here. This is about profit and loss accounting. Now, I know economics, profit and loss accounting probably sounds incredibly boring, but this has an interesting twist to it. Let me give you the highlights. Okay, so this week, for Monday and Tuesday, profit and loss accounting, here are the 3 takeaways, the 3 things you need to know from this chapter. The distinction between interest and profit, the social function of profit and loss accounting, and the limits of profit and loss accounting. So, first of all, profit and loss, the difference between interest and profit. Of course, interest is, as you learned, interest is the amount of money that is charged to a borrower by the lender for the use of those funds, all right? So interest is charged. So that's what interest is. Now, profit is the money that we make. Profit is the money we make in a business. After all of our expenses are taken out, then that's pretty much profit. Now, how this works together, interest versus profit, they actually go together. And I was using this analogy last week, but I'll talk a little bit about it again. And that is, if you're a supplier, if you're a business person, and you are in business, and you're making things, you're manufacturing things, whatever those things might be, I don't know. But you have to consider what you pay for your raw materials, your inputs, what you're making things out of. Remember, I talked about my birdhouses. All right, birdhouses. We're going to make birdhouses. So that's going to take some wood and some paint and probably nails. All right, and so those are the inputs. And so I'm going to have to pay for those raw materials, and then I'm going to have to hire people because I can't make birdhouses because I'm like not a tool person. So I'll have to hire somebody or some people to build my birdhouses, and I'll have to pay them a certain wage. And depending on how this at times, I could be paying for raw materials at a certain price with a certain dollar value. And then I could be hiring workers out of older dollars or newer dollars. So there's a value to. So what I have to do is I've got to be able to figure out what is this cost of production, what is this going to cost me, and how much can I sell it for in future dollars. Okay, so just understand that an entrepreneur has to take into consideration his inputs. Now, your book gives a really good example, and this is something I want you to see about so it says, suppose someone can spend $10,000 in buying a plot of land that contains young crop of Christmas trees. The new owner doesn't need to spend any more money. All they have to do, you bought property that has Christmas trees on it, you paid $10,000. So all you have to do is wait until December, all right, 12 months later, when you can sell 100 mature trees at an average of $30 a piece. After the trees have been sold, you can turn around and sell the land back. Let's say you only did it for 1 year for $7,300. From the revenue from the trees, after you take out from the revenue from the trees, the land sale, the entrepreneur would have turned the original $10,000 investment into $3,000 plus $7,300, $10,300. What that means is you bought the land for $10,000, you sold your Christmas trees. When you're all done, you sold the land back, you made some money on that. So the bottom line was, you started out with $10,000, you did this little thing with Christmas trees, and you ended up with $10,300 over 12 months. So you made $300. All right? And now, the question is, could I do something else with my money? Instead of, okay, that business enterprise may have been fun, it yielded a little bit of a profit, but not much. Maybe I could have done something else. Maybe I could have taken, and this is what the book says, maybe I could have done $10,000 and invested that's something else. Okay, if you took that $10,000 and you invested that money, all right, without having to do any work, and you got 5% of your money back, okay, you got a 5% return on your interest, you would have made $500 instead of the $300, and you wouldn't have done anything, all right? You could have loaned your $10,000 to somebody at 5% interest, and you would have made $500. So there's where you have to decide, where's the better investment? Does it make sense for me to go into business, or does it make sense for me to take my money and invest it at a certain percentage of interest to earn that money, okay? So there's different ways you can earn your money. Invest, or go into business and invest in yourself, all right? So that's one of the things that the book's talking about here. The other thing is the social function of profit and loss accounting, where your book, and Ludwig von Mises, the economist, he talks about the customer is always right. Maybe, I don't know if you've ever heard that, but I remember hearing that a lot. The customer is always right, because it's the customer that has demand for goods and services. And you have to figure out what that demand is, if there really is demand, and then you want to provide goods and services for that. You might be learning that with your businesses. Some of you may have had a business, and you thought it'd be a great idea to sell whatever, but you find out that whatever nobody wants to buy. So then you've got to figure out what your customer is always right. It's the customers that drive the whole thing, and that gets you to the limits of profit and loss accounting, which means for example, the book talks about, the person who, let's say you keep your store open over the holidays. Is it wise, if you have a movie theater, is it wise to keep the movie theater open over the Christmas, like on Christmas Day, all right, or New Year's Day? Is that wise to do? Well, maybe it is, maybe it isn't. Some people think, no, you should just close, honor the holiday. But what drives it is, if you open and there's sales, okay, what's happening is it's the demand that drives. It's not that the entrepreneur is greedy and wants all sorts of money, although they want to earn a profit. It's that the customer, all right, it'll be the customer. If you open up your business and nobody comes, then you're obviously not going to stay open very long. But if you open a business and all sorts of people come, you probably had a good understanding of the demand of the customers. So just because a place is open on a holiday, don't blame the owner, the entrepreneur. The consumers are probably driving that, all right? So that's what this book is talking about in profit and loss accounting. That's the big picture of what we'll be reading. I didn't get into a lot of the details, and there's not really that many details. I just want you to get the big picture from this video. I hope that helps you. You're doing a great job. I'll see you tomorrow. We'll have a terrific week.